Hello all, welcome to this new quarterly webinar session. I'm Julien Waro. I'm in charge of the EnergyScan platform here at NG Global Energy Management. So we're going to wait for 1 minute in order to give some time to our attendees to join us. Okay, so welcome to those who just join us for this quarterly webinar session. So energy markets have been shaken up by multiple supply issues, which pushed prices significantly higher recently, and even to record highs for gas and power markets in Europe. But the COVID-19 outbreak, and especially the Delta variant, continues to cloud the economic recovery despite advanced vaccination campaigns in the US and Europe. So today our speakers will try to give you more clarity on the outlook for the remainder of 2021. So as usual, Olivier Gasnier will start this session talking about key trends driving financial markets with a discussion on inflation risk. It will be followed by Loïc Balland for an outlook on crude oil markets. Then Évariste Nouki will take care of European gas and energy markets. And Etienne Covin will close the session with a focus on power and emission markets. So it's a 90-minute webinar session. So you can see the timeline in this slide here if you want to focus on a specific part of the presentation. The slides and a replay of the session will be available by tomorrow at the latest on our EnergyScan platform. So before we start, let me remind you that this is an interactive session. So don't hesitate to use the chat module to ask questions. We'll do a Q&A session after each presentation to answer a maximum number of questions. And finally, you will also be asked to fill a 30-second satisfaction survey at the end of the session. So, Olivier, the floor is yours to start with the macroeconomic outlook.
Thank you, Julien. Hello, everyone. What a change since our last webinar in April. The global economic situation has improved, and the pandemic restrictions have eased, been lifted for most of us. But the situation on markets, on financial market, has been changing the other way recently. The reflation trade that was dominant has given ground to a more cautious view. By reflation trade, I mean the prospect of return to strong global growth and also a comeback of inflation, or at least a rising price pressure that led the markets to buy small caps, cyclical stocks, or sectors benefiting from the end of the pandemic. But we have seen that they have, of course, in this first phase, first part of the year, they have moved away from traditional bonds. So bond yields were on the rise. When bond prices go down, yields go up. And the dollar also was pretty weak. But as I just told you, we have seen things changing quite significantly. If you try to sum up these changes, so we have a starting point, as I told you, where in a way the progress on vaccination meant for markets the end of the pandemic in the following weeks or months, depending on the rate of vaccination of various countries. The dominant story was in the US, the new Biden administration implementing huge stimulus packages with very strong rebound in activity. And on top of that, you had this change in the Fed's view that was announced last summer in 2020, the fact that they would tolerate a slippage in inflation without tightening their policy. Now, what is the situation? As Julien mentioned, we have a new global outbreak and flash spread of the Delta variant. On front of that, we can only see that at least for most of emerging countries, the distribution of vaccines has not been quick enough to face this new outbreak. In the US, if growth remains very strong, there has been a downward revision in the size of the second stimulus package. And the peak of growth is behind us. At least I can say that we are no more surprised positively by growth numbers in the US. On top of that, we have seen some growing concerns regarding the evolution of the Chinese economy. Even if growth numbers have remained very good, actually they have started to ease their monetary policy again. And that is clearly the sign that there is probably a slowdown that is considered as being excessive. The consensus about the Fed also has changed, because at the Fed June meeting, we have seen that there were many Fed members who were clearly uncomfortable with the view to let inflation accelerate really sharply without doing anything. And so the market has probably come back to a more classic situation where it anticipates the Fed to act if inflation continues to increase. And finally, which is the main topic of this presentation for this webinar, we have seen the supply side bottlenecks that were extremely strong in 2020 coming back. And that was pretty unexpected, and they have come back with a vengeance. And clearly the recovery in activity has faced many constraints on this side, and of course, to this respect, the resurgence of the Delta variant is not a good news. So, just to illustrate this change in the situation, some graphs on financial markets, the sharp fall in bond yields in the US. You can see that we are around 50 basis points below the peak that has been reached as soon as the end of the first quarter, just end of March, beginning of April, on a sharp acceleration of this fall recently, especially linked to the quick spread of the Delta variant. On the equity market, it's less clear, of course, and it's partly because precisely we have this level of bond yields that supports the valuation of equities. Nevertheless, we have seen some downward correction in the stock prices, and if you look at a bit more in details to this correction, you can see, for example, if you compare the evolution of stock prices in sectors that are more benefiting from the pandemic, that is to say, everything that is linked to food, for example, because you stay at home, etc. If you compare that to the evolution of stocks linked to tourism, to the fact to people mobility, I would say, such as hotel, you can see that we had this reflation trade at play since the peak of the crisis in the middle of last year, and that has been interrupted, and now we have an upward correction again, which means that the defensive stocks are doing better than, for example, hotel stocks in the US stock market. On the final remark will be about the US dollar. The US dollar has rebounded. US dollar is a usual safe haven asset on markets. And the rebound in the US dollar, of course, is a sign that people get more cautious. Yeah, so it's difficult to continue without talking about the more precisely about the this spread of the Delta variant, about the pandemic. It's a bit difficult to have a very, I would say, fair approach because everybody has his opinion about the vaccines, etc. Are they efficient, or is it necessary that they are mandatory, or this kind of really very important questions. I just put on these slides some graphs about the UK, because the UK clearly is a kind of they are in advance in terms of diffusion of the Delta variant. So it's really a key example to look at for the situation in the other countries. So you have on the graph on the right of this slide the evolution of the new cases, new COVID cases, and then new hospital admissions, and finally the death. And clearly you can see that indeed there is a sharp resurgence of COVID cases. We are almost at the maximum reached during at the start of the spring or during winter at the start of the year. So we are approaching a fast level of 50,000 new cases per day. But if you look at hospital admissions, you compare that to the situation that was prevailing at this moment, when the number of new cases was equivalent, we are far lower. And for death, it's exactly the same thing. So we can, of course, see that vaccines are efficient, and we can probably better understand why the government has continued to lift all pandemic restriction. I think, but this is my personal opinion, that they now seek herd immunity, but they cannot really admit it, of course, because people there will be some casualties in a way that there are still people at risk that who are not vaccinated, and they will be victim of this strategy. So you have still self-isolation, etc., but probably the UK government now has in mind the fact that the hospital won't be saturated, and that the best strategy is to find herd immunity before the comeback of the winter. So we can see that, of course, the vaccination rate is really the key variable for the ability of countries to resist this new wave of Delta variant. Every country is a bit lagging behind the United Kingdom in terms of vaccination, but there has been a strong improvement in European countries. France a bit lagging behind again, and we can understand also a strategy of the French government to accelerate at the maximum the pressure, or to push pressure on people who are not vaccinated to increase this vaccination rate. What we can see also is that in the US, the vaccination rate is quite high for people fully vaccinated, but the reserve is not very big. So that means probably that with reluctance to be vaccinated, the total vaccination rate in the US may remain a bit low compared to the other advanced countries. And finally, of course, what we can see is that most of emerging countries have still a very low vaccination rate, and they will have no choice but to implement a new strict lockdown measures to face this spread of the Delta variant. So some economic impact in advanced country with high vaccination rate through self-isolation, whether it is mandatory or if it is self-imposed, and also, of course, a big economic impact to come on emerging countries because of the low vaccination rate. The next slide is about the supply side constraints. If we have all these emerging countries closing most of their activities again, even if they have learned, as we have learned, to live with the virus, not to close the factories, etc., there will have some again some problems in the supply side, on the supply side, with some blockage in the global supply and distribution chains. You can see in the PMI survey, for example, that the delivery times have increased sharply in advanced countries. That reflects problems of shortage in some sectors. On the I would say the most obvious example is in the automotive sector, where the shortage of electronic components has really blocked the production of cars, while the demand was extremely strong. You have seen, for example, the sharp rise in the prices of used car in the US that reflects this situation, because in a way, the people will stay in their country or will not go abroad for their holidays, and so they need a new car probably in many cases, and they cannot buy it because there is a shortage or there is a lack of production. You can see the evolution of production of motor vehicles in the US, in the whole EU, in Japan, a big car producer. The trend is clearly down while the demand is extremely strong. And there is another supply constraints, more specifically in the US, which is linked to the situation of the job market. In Europe, for example, we have faced the crisis by providing financial supports to companies to maintain people, not to fire people, and to limit the rise in unemployment. That has not been the case in the US. There has been a sharp rise in unemployment, and after that, of course, a strong rebound in job creation. But that has created bigger problems. There are problems of adjustment now between supply and demand on the labor market. And we can see that very clearly through the surveys, and especially for small companies that report that they have never found jobs harder to fill, and they also feel constraints to produce more because of the lack of labor. So that brings us back actually to our first question. So are markets right not to fear inflation anymore, finally? Because this is what has happened. If you look at the evolution of bond yields, that clearly reflects the conviction that inflation will not be a problem. Yet we have seen a sharp acceleration in prices, as shown on the graph on the left. Sharp acceleration mainly due to, it's true, to the strong basis effect on oil prices. But you can see also that there is clearly a specific US problem. Total inflation has reached 5.4% in June, and core inflation that exclude precisely food and energy prices has reached 4.5% on year-on-year basis. That was the highest level in 30 years, the highest level since 1991. So clearly, what is important is to look at inflation expectations. If you look at inflation expectations on markets, the markets, they follow the Fed in the way that in the opinion that this surge in inflation will be transitory. It will only come from tensions linked to the COVID crisis, and all that will disappear rather quickly, less than a year if you want. And so they are quite confident. There has been an acceleration in inflation expectations. You can see on the orange line. but these they have come back close to 2%, which is more or less the Fed's target. If you listen to companies, if you listen to consumers, this is clearly less the case. I mean, they are more worried, and of course, this can create the conditions of an acceleration in wages, which would be really the key variable to build durable inflation tensions in the US. For the time being, when you look at the evolution of wages, you have here on the graph on the right, the evolution of wages on a monthly basis. You cannot see really signs of acceleration in wage increases. If you look at the 12 months average, the 3 months average, yes, it's a bit on the rise, but for now it remains rather stable overall. So there are no sign for the time being, no worrying sign on this side, but this is clearly something to look at. Because if that changes, that means the Fed will probably have to react on all, this fragile equilibrium, in particular for the equity market, could really collapse if bond yields were rebounding sharply. So I encourage you to look at these kind of numbers, as variables. Look at wages in the US. This is where probably you have the answer to the tensions on US inflation, on the pursuit of a kind of optimism on markets linked to the low level of bond yields. Thank you, and I'm ready to answer some questions if you have.
I have two questions for you. First one, what is your outlook for the Euro-USD rate in the coming months?
Well, I have changed my forecast. I mean, I explained that in the last monthly report. Why? Because of the change in the Fed's position. I mean, it's not an official change in position, but clearly we have seen that not everybody, as I told you, inside the Fed is really comfortable with the view that the Fed could let the inflation slip without doing nothing. And I think that changed completely the situation, because that means that the Fed would react if tensions on prices continue to be strong as they have been in the recent months. So I think in the long run, I keep my view that the US dollar is overvaluated, that the high deficits of the US, whether you look at the external deficit or the public deficit, will weigh negatively on the US dollar in the long run. But say for the next 12 months, I don't see really the euro rising against the euro dollar. So I'm more in the view that there could be a kind of pause around the current levels for the euro dollar.
Okay, thank you. Regarding inflation risk, so you said that the Fed's view, which is shared by markets, is that it will remain transitory. But what is your opinion about the impact of all the net zero CO2 emission pledges for 2050 or 2060 in most developed countries? Will that lead to a sharp rise in global inflation in the coming years?
Yes, probably this is something that is out of the scope of markets for the time being, because they are more focused on short-term issues. But yes, this is something that will be important, that could push prices higher. And if we have precisely, if that starts, as it is the case in a period where you have also a strong demand that is fueled by strong stimulus from the fiscal policy in the US and the tensions on the job market, that can favor some acceleration in wages in anticipation of this. And on top of that, you have seen the social movements in Europe. We know that in France in particular. So governments have learned that it would be difficult to implement these reforms without adopting in parallel a more accommodative social policy. So that all that can lead to an acceleration in revenues on this side, and yes, that can favor some acceleration in inflation. Yeah, I think so in the long run.
Okay, thank you, Olivier. So now it's time to move to the oil part of this presentation with Loïc Balland. So Loïc, you can
Hello,
start.
everyone. I'll start by addressing what Olivier said on the reflation trade and the kind of impact that it had on the oil market, because the title for today's presentation was are we at OPEC's mercy for the oil market? And the recent move that we experienced on Monday. So just for a bit of a look back, we went from $73 a barrel for a Brent crude at the prompt to about 68 within a matter of hours. And that change in prices did not reflect any really big fundamental changes. If not, there was less fundamental uncertainty. So what has happened, which is the most likely explanation, was that as bond prices collapsed, we had also a downward revision in inflation expectations. And oil prices often, as Olivier said, it's a big component of the inflation in the US, and it also therefore impacts bond prices heavily. So it is used commonly by financial investors, non-commercial players, to hedge inflation. And so we saw this sell-off and really this big outflow from commodity markets to recalibrate that reflation play. We can see that more specifically here on the first chart. This is the positioning from swap dealers. They're usually the counterpart of end users and financial players. And we see that the long exposure in the futures market has decreased significantly. And the elevated volatility that the OPEC meeting brought in early July, as you can see on the second chart. So usually oil volatility is about 20 points higher than equities. It was since July significantly above that. And that also forces institutions and financial investors to reduce their positions and deleverage in the futures market. So everything was kind of a catalyst for this big move that we saw on Monday, really outsized move given the fundamentals. And we'll try to unpack the fundamentals that will really play out for the next, let's say, 1 to 4 months. Looking at what OPEC has done on Sunday, they managed to broker a deal. So this deal is broadly the same as the one that was suggested in early July, but failed because the UAE asked for increased production quotas. As of now, the OPEC Plus group will try to increase production by less than 0.4 million barrels per day from August to April 22. And past that date, the big Gulf countries and Russia will have increased baselines to reflect the fact that they they had a large spare capacity for the last year or so, and they need to account for that in the kind of OPEC group. Still, if we look a bit closer at what has been the compliance of the group, there's been a consistent over-compliance. So they're producing less than what they were expecting to on average. And this is not really what they were probably envisioning. As you can see here, Russian production continues to struggle to ramp up above 10.5 million barrels per day, even if their quotas is actually higher. West African nations are also affected by similar issues. And we think that actually, even if they are mandated to increase production, the production in reality will be slightly less than that. And this can really affect oil price on the upside if OPEC under delivers, because all crude prices are kind of have priced in that the current framework for future OPEC production. You can see that in Q4 21, we have in the first chart, you can see the orange bar. This is the Iranian comeback. So we have, this is still quite, you'd say speculative, but we think Iranian oil will come back in Q4 21. And you can see also that in late 22, we have Venezuelan oil production coming back. And so those are also two big assumptions that we want to place in our forecast, but are very speculative. And without that, that would require significantly higher call on OPEC for other producers. So that's something to watch. And we see that we're increasingly relying on what we would say geopolitically sensitive countries here with Venezuela and Iran and so on. And that has usually increases the security of supply risk, and so improve the price expectation. In the very short term, summer crude balances continue to be tight. We are anticipating a 2.8 million barrels per day deficit. So that's the difference between supply and demand in the market during September. And we think that throughout the summer, from early July to late September, we're going to draw 260 million barrels of crude oil. It's going to be mostly located in the US and Europe, as we saw that OECD Asian countries are actually building a bit, according to satellite measurements in early July. But we still see that as a fairly constructive move for crude prices. And what could affect this summer deficit? Well, not that much. If you look at US production, it has risen recently and surprised to the upside. We reached 11.4 million barrels per day. You can see on the second chart this kind of uptick lately. But if we account for just the classic, let's say, the average outage in the hurricane season, the fact that the labor market is extremely tight in the US, and it's quite hard to find frac spread equipment and people to really materially improve the situation in terms of US production, we think that this situation will kind of take months to sort out, and US production will remain below 11.5 at least for the next 5 to 6 months. So with US refining runs increasing quite heavily and remaining at elevated levels because US demand is quite strong, this is quite an opportunity for US crude prices to rise against European benchmarks. The second thing that we're seeing more on the demand side here for the summer is that we have mobility rising pretty much everywhere. If you look at Europe and the US, you see that we're already past the peak of last summer, but also earlier pre-pandemic. If you look also at Brazil and India, which were quite affected by the pandemic over the last 3 to 4 months, you can also see that it has also risen significantly and even above other regions. The only issues that kind of clouds this outlook is Southeast Asia. You can see here Thailand, which is a good example of a population with lower vaccination coverage and issues with mobility here. And so while this is a concern for the oil market, this southeastern region, and also OECD Asia, meaning Japan, Korea, and Australia. If you look at the US and Europe, we keep being consistently above what we expected. So you can see here flight data, daily flight data in Europe, and you can see that it's ramping up extremely rapidly. It's the same picture for US flights. And so just by looking at that chart, you can see that we're looking at at least 1 million barrels per day, if not more, demand increase within the summer. And so that's really the key for the oil market to improve in terms of prices and so on, because kerosene is such I'd say, an important port for European runs. And increasing this demand will greatly improve their crude throughput, and that will, of course, affect the crude market. So just in terms of to sum up and looking at prices, we kind of, in terms of time spread, we declined a bit recently with the decline in flat prices of Monday. We still think there's some upside here, especially on the short-term time spreads, as we see steep stock draws. And this is, of course, supported by European refiners now earning profit margin that is significantly better than the rest of the year, and we see a global rise in demand. That's it. Maybe I can address a few questions if you have some.
Thank you, Loic, for this presentation. Yeah, I have a question for you. Classical one. So what is the main uncertainty regarding crude oil fundamentals in the coming months?
Yeah. Main one remains demand. If you just look at prices where they're at, how much refiners have bought crude and they're willing to process in the next months or so, you're looking at refiners anticipating growth in demand that is quite unprecedented. So they're probably provisioning for like let's say a 3 to 4 million barrels per day increase at a global level in demand. If that doesn't materialize, meaning that, as Olivier said, the Delta variant keeps limiting mobility, or flight numbers continue to be sideways, that's going to be an issue, because then we'll see a global glut in refined products, and that will affect price on the downside after that. So these expectations in demand that we have currently, they're high. They're also, we have evidence that people are rapidly going back to driving and flying and so on just after the pandemic. We saw that in the US and so on. So these are reasonable expectations, but they're high, and so that could be the issue.
We have a question from the chat room. So how do you see refinery margins in the near future?
Yeah, great question. So refinery margins are experiencing two things. On a structural side, refining margins are kind of pushed downward because we have so much refining capacity globally. Every nation wants to more or less have security of supply for their own refined products. And so you see a lot of countries just building refineries or maintaining refineries. That's the case in Australia, even if they're uneconomical. And that creates, of course, really depressed refining margins at a global level. If you just look at historical levels, we're extremely low. we're currently at $7 to $8 a barrel for cracking and transforming crude to diesel, and that's levels where we have really a difficult time making any profits out of cracking barrels of crude. Although in the so that's the structural part. Less on more on the short-term part. There's going to be this kerosene demand that's really going to affect whether or not refining margins go upward or stay flat. If jet demand continues to surprise to the upside, as we saw here, or just go back to some sort of normalcy, then the diesel cracks will greatly improve, and it will lift global refining margins quite heavily. So that's the key variable I'm watching if I want to have a forward view on refining margins in the near term.
Okay, thank you, Loic, for your answers.
Thank you.
So let's go back to the presentation with Évariste for the natural gas outlook. Évariste, are you there? Okay, so it looks like we have a technical issue with Évariste, so maybe we can switch directly.
No.
Oh,
Okay.
Évariste, you there?
Yes, I'm here.
Okay, great. The floor is yours.
Okay, thank you. Hello, everybody. So we'll talk about the anatomy of the rally in gas prices. Of course, we are at historical highs. But what we can say is that, unfortunately, this rally is backed by fundamentals, so it's not really a surprise. Starting first with fundamentals on demand. So we'll move through this first slide showing the trend in residential tertiary demand, or what we call LDC, the demand, before moving to demand for power generation. In June, if you look at the graph on the left, we just say that we came back to normal levels in June. But if you look at the trend since the start of the year, we are clearly upward. We are upward by around 17% if you take this category of demand. And what is also surprising is that we did not just come back to the levels of 2020, the levels of last year, as you imagine, with rather low levels at the start of the year because of the COVID-19. But if you look at carefully the graph, we are above the historical range, meaning that this is clearly a significant rise in demand coming from this sector. And on the power side, of course, the trend is much more volatile because you have to take care about the competitiveness with coal. But on this power side as well, since the start of the year, on average, we are at plus 11%. Of course, you have some volatility depending on the months. And the country where you can see clearly what happened recently is Germany. If you just look at the table which are below, from May, you see that in Germany, gas-fired generation dropped quite significantly. And at the same time, this was the opposite for coal. This is clearly the indication that from May, we start to see gas losing competitiveness against coal. And this ended up with a sharp increase in coal-fired generation. Since the start of the year, on the coal side, we are at around 27%, which is quite huge. So this is part of the explanation of the rally on the demand side. And we'll see that on the supply side, we do not have a strong reaction of supply just to cope with this sharp increase in demand. Starting first with our main supplier, which is Russia. Since the start of the year, flows through the Nord Stream 1 pipeline are rather stable. You can see the graph on the left. Of course, we do not have yet all the values for 2021, but they are stable for the first half of the year on the Nord Stream 1 side. While via Yamal, the transit through Poland, we are at plus 28%, quite significant. But what is worrying clearly the market is what is happening with Ukraine. Ukrainian flows were already down in 2020. They dropped to 39 BCM, billion cubic meters in 2020, while they were at 58 BCM in 2019. So already a quite significant drop last year. And this year, we are following the same trend. Since the start of the year, we are at minus 25%. This is quite huge. And we just have to acknowledge that exit flow at Welke Kapusani, which is at the Ukraine-Slovakia border, they are capped and they are well below the technical capacity. And this is the case, in fact, since end of 2020, with Gazprom not booking entry-tubal capacity at that border. So this lower level of Ukrainian flows is clearly the main market concern, and you'll see that this explains why we are such in trouble on the European gas balance, leading to rather low gas stocks. In July so far, we also have some additional issues, but these are normal because these are planned maintenance, both on the Yamal, that start with Yamal. Then the Yamal pipeline resumed. Now it's the Nord Stream 2 pipeline, which is closed since 13th of July for 10 days for planned maintenance. And of course, you can imagine that this is cutting additional Russian flows and putting a stress in the European gas systems. On the Norwegian side, flows are a little bit higher compared to last year so far. Flows dropped significantly in June due to a set of planned and unplanned outages. But since the end of June, they are now rebounding. But of course, we are very, very low. If you make a sum up of pipeline flows, we are very low compared to what the market needs just to cope with the additional flows in demand. So this is for pipeline supply. If you move to the LNG side, starting first with what is happening in Asia, you have to see that Asian flows are significantly up, starting with China. Since the start of the year, we are at plus 27% compared to last year. Leading total Asian flows to plus 12%. And of course, supply is not increasing at such levels. If you take the graph you have on the right is the actual exports, but if you think about liquefaction capacity, additional liquefaction capacity, we are at around 5%, of course, far below the level Asian players are asking. This just means that there are now few volumes left by Asian players for other regions that will contribute to tighten the market, the LNG supply for other regions. Particularly as on the liquefaction capacity side, we are now entering the maintenance period. Now you see that June, July, August, you have a lot of maintenance, seasonal maintenance that is cutting now supply. At the time, Asian players need the flow. So this is putting additional stress on the system. And on top of that, we also have some technical outages on some liquefaction plants. So weak LNG supply to Europe. At the time, pipeline supply is also weak. LNG supply to Europe, if you took if you take the value for June, now we are of course very low. You can say that this is seasonal, of course, explained by what is happening in Asian demand, and also what is happening on the supply side in terms of maintenance. And we are close to the levels of last year in June. But of course, the market doesn't care about that seasonality. The market needs the flows now, and it just has to acknowledge that the flows are not there on the LNG side, which is maintaining the tightness on the market, limiting net storage injections. So you have the graph in the middle, which is showing that we are now, we were below historical levels in April, May. In June, we were rather close. The same in July, but we are close while stocks are lower, meaning that we would have love to see net injections being at higher levels. So this is clearly an indication of a tight market. And on the LNG side, we cannot expect to see additional volumes in the near future because if you remember the previous slide, Asian players, they are now in their summer peak. So July and August, the maximum demand. And in this period, they need additional LNG. So no way to see flows coming back to Europe. And we have even to care about the situation to last beyond August. As you can see, the spread, just look at the graph on the right, we see that now that the spread between Asia and Europe is increasing, meaning that they need additional LNG through October, November. So this is a clear risk for the European market to see weak LNG flows continuing through the end of the year. What could be a positive news on this outlook? You have to see it on the Brent side, on the oil side. As you can see it on the graph on the right, it seems that European prices are capped so far by the Brent level, which is not the case in Asia. So for Asia, we have to look at carefully what will happen in the coming days. The oil price doesn't manage so far to cap the price, the GKM price on a forward basis. It is still roughly the case on the spot. So we have to monitor clearly this indicator. If this happens, it just means that in Asia, you have maybe some players, they can be on the power generation side, you still have some substitution. They can be also on an industry, you still have some physical substitution as well. If it is the case, it means that we'll see some demand destruction on the gas side because of switch to the oil market. We are not seeing it right now. You have to wait a little bit because this is rather new. It's rather new that GKM prices jump to oil levels, and you'll see clearly in the coming weeks if such substitutions happen. If they happen, we can see GKM prices, Asian prices, being capped by the oil level, which of course an impact on European prices just because we'll destroy part of the demand in Asia, meaning that Asian players will take less LNG. If they take less LNG, this LNG will be available for European players. But we have to be careful about this, let us say, optimistic outlook. Remember, just look at the graph. In December and January, it was not the case. GKM prices jumped far above oil prices. But if you want to be optimistic, you can say that in December and January, the market was not prepared for that. Market was in a bearish configuration, not prepared to make quickly the switch. This time, Asian players know that this can happen. They are prepared for that. You have a lot of pressure on the Asian utilities in China, in Japan, to rebuild their stock, and a lot of pressure also for industrial to set up some substitution to measure. So we can hope that this time, maybe if these possibilities of substitution exist, we can activate them more quickly. This could be an optimistic outcome on the Asian side with an impact for Europe. But for the time being, prices are up, clearly up. So we are at all-time highs. But if you look at clearly the trend on the graph on the left, of course, unfortunately, prices are higher, historical high, but it is not really a surprise because we are just maintaining the bullish trend that started in March. Why March? Because March we were at the ending, the end, roughly the end of the heating period, and stocks were very low, as you can see it on the graph, which is just below. Very low stocks at the end of March, meaning that the market knows that by the injection season will be quite difficult, and it is since that period that prices were up, which is materialized here by prices clearly trading above their 20-day average, which is in terms of statistics, mean that the trend is bullish. The 20-day average was up and prices were trading above that 20-day average. So clear indication of a bullish trend. From time to time, we can have some drop triggered by profit taking. And also in May, we have, if you look at clearly the graph, in May, we also have some drop triggered by the decision of the US administration not to impose sanctions on the developer of the Nord Stream 2 pipeline. But apart from those period, the trend was clearly bullish, amplified from time to time by the decision by Gazprom not to book additional capacity, indicating clearly that there was no intention to increase flow via Ukraine. So at the end, in a configuration of strong demand and low LNG supply, of course, you can imagine the impact on stock levels. So stock levels, if you take the value as of the 18th of July, we were full at 51%, significantly below last year's level, 84. And even because you can say last year was a particular year, but even if you move back to 2019, you were at 79. So very low stocks levels, meaning that given the tightness, we continue to have to destroy demand to make room for storage injection. And the only way to destroy demand, the sector where you have this flexibility to destroy demand is clearly power generation. That's why, just look at the graph which is on the right, clearly gas prices, they started in Feb to follow the rise in what we call the parity price we call for power generation. And starting June, they jump above that level. This is the clear indication that the market from that period just say, okay, now, given the low pipeline supply, the low LNG supply, the strong demand we have for residential, the only way to make the European gas system be a little bit less tight is to destroy demand in the power generation sector. So we have to push gas prices above the parity prices with coal and destroy part of the demand. And this is clearly what we saw. Remember our first slide. From May and June, the sharp drop we saw on the gas demand for power generation. This was the condition to try to make our gas system come back into balance. The bad news in this outlook is that the trend of the parity price with coal for power generation is upward. And as a reminder, this is a combination of coal prices and EUA prices. On the EUA, HN will come back to it in the next section. But on the coal side, what we can say is that, of course, we know our Asian players, China, Japan, South Korea, the three main LNG buyers worldwide. We know them on the side, on the LNG side, but they are even more important for the coal market. So the tight power markets we have in Asia, okay, this tightness is fueling a rise in LNG purchase. But this tightness in the power market is also feeding a rise in coal prices. So this gray line combination of EUA and coal is rising just because coal prices are very strong, because in China, in Japan, in South Korea, utilities, they are increasing quite significantly their coal purchase. So this is the bad news for the gas market. It just means that as long as EUA and coal prices increase, this gray line will continue to increase and then lend support to gas prices. So on the Russian side, clearly, we say that the solution can come from Russia. Flows are very low. We have a lot of uncertainty about Nord Stream. In the graph on the left, we just like to make a kind of scenario of what could happen in the coming months. By taking some assumptions on the demand side, we estimate that roughly for this year we can end up with plus 5% of increase compared to last year. LNG supply will maintain the trend, will be down by 6%. On the Russian side, we maintain a stability, but also taking care of the seasonality. You know that for sure, normally, at least, flows will be higher for the winter period. If you take these assumptions, in fact, you have the resulting graph, which is there. And this shows that clearly the market will remain tight through March, with stocks level very low. We were a little bit above, let us say, around 20%, compared to 29% last year, which was already a very low stocks levels. This is just to tell you that if you don't have additional supply from Russia, we'll be in trouble, of course. Stocks will be quite low. And the situation could be even worse because in these calculations, in fact, we assume that we still have flows from the Yamal pipeline, the Polish transit. And there is also an uncertainty about flows via Poland. So let's hope that we'll have the Yamal flows, and the uncertainty will be only on Ukraine or Nord Stream 2. The optimistic view could be to say, okay, by the end of the year, we'll have Nord Stream 2 up and running with additional flows, or at least, if it is not the case, Russia will decide to push flows via Ukraine. If this happens, yes, we can come back to a situation much more comfortable with, of course, a downward trend on prices. But what is shown so far is that the market is clearly very uncertain about Russian supply, and this uncertainty is translated into high volatility. Just to the example of the TTF, look at the graph on the right, TTF month-side prices, with the possible trend until the end of the year. Currently, prices are trading about, for the balance of the year, a pivotal value of 35 euro per megawatt hour. But given the level of volatility, we estimate that prices can rise or drop by 5% around this pivotal value, knowing that, okay, you know that pivotal value can also change because that pivotal value is given by the trend. But just to give you an idea of the volatility, 5 euro per megawatt hour up or down, just depending on the current volatility. If you have news about Nord Stream, positive news, you can say, okay, maybe you can lose that 5 euro starting point quite easily. And of course, if you have the negative outcome, you can rise by 5 euro. And those levels you can also clearly imagine and link them to fundamentals. 40, an increase of 5 euro to move you to 40 just means that you are jumping to the current Asian prices. While on the other side, if you drop by 5, you come back a little bit below the coal switching level, meaning that, of course, if you have additional volumes from Nord Stream, it means that you don't have to destroy more demand in the power generation sector. So you can drop quickly to around 30. So very quickly on the calendar 22 price trajectory, the main message here is that clearly, given what is happening on the fundamental side, we revise upward our max price trajectory. Before we had a target at 18 euro per megawatt hour by the end of the year, let us say end of December. We move it to 21. We believe that clearly prices, now the fair price for 22 is around that level. Depending on the evolution of the risk premium, mainly from Russia, the calendar contract could come back or not before expiration toward this level. Last slide about the trend in far curve prices, just to acknowledge the strong backwardation. Calendar 22 prices still very strong compared to prices on more distant maturities. And here you have to be careful about this backwardation, and particularly about what could happen from 2023, because we believe that from that period, the gas market, particularly the LNG market, will be tighter. Because the addition of liquefaction capacity will be low compared to the expected rise in demand, particularly in Asia. That's it for me, Julien. So if there are some questions, maybe I have some time to take them.
For this very interesting presentation. So yeah, we have several questions from the audience, mainly regarding the Russian gas outlook, of course. So I'm gonna take one of these. So with the very likely Biden-Merkel agreement on Nord Stream 2 and the Ukrainian gas transit, the restart of Nord Stream 1 after the annual maintenance, and cooler temperatures to come across Europe, would you expect Q41 and 22 prices much lower than their current levels?
Yes, our simple answer will be yes. If you take the restart of Nord Stream 1, of course, this will have a small impact, but this is expected. We know for sure that there is a maintenance for 10 days. So, of course, I'd say that the market is expecting this one. Cooler temperature will have also some impact as well. So it can help a little bit. But clearly, the main factor that could impact significantly the market is what will happen with Nord Stream 2. So late on Monday, there was news about a possible agreement between Germany and the US. Of course, if this is acted by the meeting with Biden and Merkel, yes, of course, we believe that this will have an impact, a strong impact on prices. And as I mentioned, to imagine we know the impact, prices will be lower, and then to imagine the level of the drop, you have to reverse to what I was talking about, the level of volatility, starting with, of course, maybe you can drop by €5 on the months ahead. On quarter and calendar contract, yes, the drop will be, of course, lower because volatility is low.
Okay, thanks. Just one last question because we are running a bit short on time. For the longer outlook, for what impact on European gas markets and gas prices would you expect in the midterm from the EU Green Deal and the Fit to 55 package, with targets to lower methane emissions gradually by 2050?
Yes, no, interesting, but not easy question, no? No, yes, it's an interesting question, so that's why I'm happy to answer it, at least to try to give some insight. Yes, the first let us say, first step is to say this will have an impact on demand. We are trying to reduce the carbon footprint of your gas consumption, meaning that if you talk about gray gas, because on the market we are talking right now on the gray gas, this will have an impact on demand. Also, you can have also a kind of spread in the market. As you know, not all the gas volumes are equal. Huh? Some of them have a lower carbon footprint. So you can have a market which could be split between low carbon and high carbon footprint. But overall, let us say you can have a drop in demand. But this is on the demand side. But as you have a drop in demand, you have also to think about supply. If you have this drop in demand and supply at the same time remain at such a level, you say, of course, easily we have a drop in prices. But it will not be the case. On the supply side, you can have also some constraint that will tighten your gas supply. And I'm afraid that overall, we are not sure that this will end up with a drop in prices, and it could be even worse. This is for Europe, but think also about Asia. You will not have the same constraint on the Asian side. So on Asia, if you continue to have a strong demand for grey gas, it means that you can tighten even more your market on the LNG side and with an impact on the European market. So overall, I will say that you'll have a split in markets, so a much fragmented gas market with higher volatility, to be sure, and probably higher prices.
Okay, thanks a lot for your answers, Evariste. So it's time to move back to the presentation with Etienne for power and emission markets.
Yes, thank you, Julien. Good morning, everyone. So as usual, I'm going to present you the recent evolution of the European power and carbon market. But today I will focus a bit more on the recently published European Commission's Green Deal proposals. So first, let's have a look at how the carbon prices have evolved over the past weeks. So as you can see on the left chart, the carbon prices have surged over the first half of May, and there are actually two reasons behind this surge. The first one is, of course, the spiking gas prices. You can see them on the middle chart. So basically, they increased the competitiveness of the more emitting coal power plants, and hence the short-term demand for carbon allowances. But that's not all. On the other hand, you also had a stronger speculative buying induced by the European Commission, which dismissed all rumors of a lawmaker's intervention to stop the speculation in the carbon market. Each time the carbon prices surge to new levels, we see this rumor emerge. And basically, the vice president of the commission stated that an intervention would lead to a non-market-based prices, and it would undermine the credibility of the market. And in any case, the European Union would need much higher prices. It did not mention any specific amount, but it said that the European Union would need much higher prices to reach its recently raised target. So from mid-May, as you can see, the price collapsed, actually strongly corrected. It was mainly induced by the speculators taking profit from the massive rally from the previous weeks. We also saw some correction in the wider market. So you can see it on the gas market in the middle chart. And basically, it coincides with the UK ETS launch. And we saw the UK emitters sell back their proxy hedges with EUAs to buy the equivalent amount of UKAs for their compliance needs. So this added a slight pressure on the market. And in the following weeks, we saw the carbon prices hovered between 50 and 55 euros per ton, because at 50 euros, we could see some quite strong buy interest materialized from the operators, so the emitters on one side, but also in the long-term investors on the other side. And on the other hand, when prices got near 55 euros per ton, we saw some pressure from the looming free allocation of the EU ETS, the sell-off of the UK emitters progressively swapping their EUAs for UKAs, and of course, all the uncertainties regarding the coming European Commission's proposal, which I'm going to present in the next slides. Mid-June, the carbon prices started to surge back and reach a new record early July near 55 euros per ton. This time it was mainly due to the spiking gas prices. And what's interesting to notice, and I invite you to look at the right chart this time, is that for the short-term contracts, so basically the front months to front quarters, the coal to gas switch levels rose above the carbon prices, which means that for all those deliveries, it's more cost effective to produce electricity from the coal power plants than the gas power plants. And of course, it had an impact on the power prices. Okay, so now that you have a clear view of the current level of prices, let's dive into our main subject of the day, the European Commission's Fit for 55 package. So as I'm sure you all know by now, last week, the Commission published a wide range of legislative proposals in order for the European Union to reach its recently raised 55% emissions reduction target by 2030. The previous target was fixed at 40%, so it's a much more ambitious target. So some of the reforms had already been leaked over the past weeks, but the main remaining unknown regarding this publication was the share of the emissions reduction burden attributed to the EU ETS and to the non-ETS sectors. And last week's publication finally answers that question. So for the EU to reach its target, the Commission actually proposed to increase the EU ETS CO2 reduction goal, which is a different one from the wider EU one, to 61% from 2005 levels. And this is once again much more ambitious than the current 43% emissions reduction target. So essentially, it would mean that the 2030 ETS cap, as you can see on the chart on the right, would be reduced to about just above 800 million tons, which is 380 million below the current design of the EU ETS. But how that stricter target could be reached by the EU ETS? Well, first, the Commission proposed to increase the linear reduction factor from 2.2% to 4.2%, so nearly doubling it in the year following the entry into force of the legislation. Basically, that means that the Commission did not specify an implementation date, but rather would like to see it implemented as soon as possible. This new LRF would represent an 82 million yearly reduction of the ETS cap, which is much higher than the current 43 million tons, as you can see on the light blue curve. But if you consider a 2-year legislative procedures and negotiations, which in my opinion is still quite optimistic, this higher LRF would be implemented only from 2024. And to compensate for this, the Commission plans to, on top of the higher LRF, to carry out a one-off rebasement of the cap so that the LRF has the same effect as it would have applied from 2021. This actually means that the sooner the proposals will become law, the smoother the cap will decrease. Basically, the lower the rebasing will be, and the lower the impact could be on the carbon prices, although it will be on the shorter term. As for the overall impact on carbon prices from these two reforms, so the new target and the higher LRF and rebasing cap. So basically, these two reforms are fundamentally bullish because they imply that the allowance supply will be much tighter over the phase 4 of the system. You can see it in the red line. The cap will decrease much strongly. But on the other hand, it had a neutral impact on prices because it was largely anticipated by the market participants and it came really in line with the market expectations. So it was mostly already priced in by the market. Okay, let's go to the next reform. So a second reform of the ETS would concern, of course, the market stability reserve, but unfortunately not much use there either. So as expected, the Commission proposed to extend the MSR intake rate of 24% beyond 2023. And actually, this could speed up the absorption of the market surplus and could be slightly bullish for the market prices. But it also added a little twist by proposing to implement a dynamic intake rate if the TNAC fall between 1,096 million ton and remains above the 833 million ton threshold. So basically the intake rate, and it's displayed here, it will be much more, sorry, I had to put the slide on the next slide, but just have a look at the chart. So basically, the the intake rate would take a value between 0 and 24% based on the difference of the TENAC and the upper threshold. So basically, in the histogram, you can see the previous year's surplus. And if this surplus fall, so the MSR intake rate would remain at 24% for the remainder of the phase 4 of the system if the TENAC remained above 1.1 billion tons. If the TENAC fall between the second range, so the range between the two red curves, the MSR intake rate would change, depend, and would be based on the actual number of the TENAC. Below, so between the 400 million tons and 833 million tons, there would be no MSR withholding. And finally, when the TENAC fall below the lower threshold, part of the EUAs withheld by the MSR would be reinjected in the market. And we actually see this happen in the second half of the fourth phase of the EU ETS. Okay, so let's just get back on the previous slide. As for the free allocation, actually the main change is that the free allocation will be conditional on operators carrying out energy efficiency audits and investment improvements. If they do not carry these activities, they could see their free allocation volumes being reduced by 25%. So it's a pretty strong incentives. Okay, so as for the widely debated EU ETS extension reforms. So first, the aviation, which is already partly covered by the EU ETS. So the main changes for the aviation sectors, planned by the Commission, would be to increase the sector's LRF for the stationary installation, which is quite unsurprising, but also to quickly phase out the free allocation of this sector. So as you may not know, currently only 15% of the aviation sector allowances, so the EUAs, different from the EUAs, but functioning on a similar pattern, are auctioned. In its plan, the Commission planned to increase this ratio to 25%. So 25% of the specific allowances would be auctioned in 2024 and gradually increase this ratio until from 2027, all the allowances are auctioned and there are no more free allocation for the aviation sector. But more surprising, the Commission proposed to extend the scope of the aviation sector to extra EEA flights. So EEA is the European Economic Area, basically the European Union 27, and Liechtenstein, Norway, and Iceland. And the Commission planned to also include part of the emission from the aviation flights outside this scope. But actually, it would not be as bullish as you could expect, as this reform would align, according to the proposal, with the CORSIA market already existing, and hence include a lot of exemptions, which would strongly limit the actual impact on the supply-demand balance and therefore on the prices. And otherwise, it's likely to face a strong opposition in the international. Now, regarding the maritime sector, which, as I'm sure you all know, has been strongly supported by the Commission and Parliament and widely discussed for several months now. So the Commission, unsurprisingly, once again offered to include the emissions of the sector directly in the EU ETS and as soon as 2023. So the scope proposed is, however, a bit larger than expected, as it would include the emissions from the intra-EEA journeys, the ships berthed at EEA ports, so quite similar to the current scope of the aviation sectors, but also 50% of emission from the extra EEA journeys. This could turn out to be bullish for EUA prices, but it's actually similarly to the aviation sectors, likely to face a strong international opposition, which might lead to a reduced scope, as it did for the aviation sector when the Commission implemented it. And in any case, as for the impact on the supply-demand balance and on carbon prices, it will depend on how the ETS cap is adjusted to the sector. Another complex issue due to their very high carbon abatement costs, is the integration of the road transport and the building emissions. So for these specific sectors, the Commission plans to create a new and separate ETS with compliance obligations from 2026 and no free allocation. But basically, it would have no impact on carbon prices because it would have no link with the EU ETS. And in any case, this reform is the least expected to be approved by the Parliament and the Council after these proposals, due to its potential socio-economic impact, as most of the cost would be passed through to the consumers. And I'm quite sure all lawmakers would prefer to avoid another Gilets jaunes crisis. Which leads to the last reform and perhaps the most important ones. And of course, I'm talking about the carbon border adjustment mechanism. So in the Commission's proposal, the carbon border adjustment mechanism would cover the steel, iron, aluminum, cement, electricity, and fertilizer sectors. The CBAM would be applied with a transitional period from 2023 to 2025, where the importers would only have to report their emissions. But from 2026, the covered sector would have to buy specific non-tradable allowances equivalent to their emissions. So basically, they would have to buy specific virtual allowances from a dedicated pool, and they would have to surrender the equivalent number based on their emission. The certificate prices would actually have a price based on the average EUA auction price from the previous week. And this is the link with the EUA prices, and this is let's say the bullish risk for the carbon prices, as the importers could tend to build hedging position with EUAs in order to comply with their CBAM obligations. So this could add a demand on the EU ETS and support prices. Moreover, as the CBAM aims at protecting the industry from the international competitions, the free allocation of the cover sector would no longer be needed and would be progressively phased out from 2026 and fully removed by 2035. And similarly, we could see the related sectors increase their hedging positions due to this mechanism. Which leads us to our outlook. So as I said before, most of the reforms presented last week were largely anticipated and came in line with the market expectation with no big surprise. ICCRN even anticipated the 61% new target. So really it had almost no impact on prices. The EUA DEC 21 surged by 6% as a publication, but quickly eroded all their gains in the following hours. Regarding our short-term outlook, so now that the proposals are published, the EUA seems to be looking for direction, and this could actually keep the gas market as the main driver of the carbon prices in the upcoming weeks, as it did in the previous months. The speculators seems to be in a wait-and-see approach currently, but they could induce a sell-off if they decide that the legislative proposals are not strong enough. But they might face a quite strong resistance at 50 euros per ton, where we saw over the past week a strong buying interest materialize. But basically, you should keep an eye on the speculators, so investment funds and other financial institutions displayed on the upper chart, and see what they are carrying out, because it could impact the market quite significantly. So still in the short term, besides the directions given by the gas market, the emissions prices could be torn between the annually lowered auction volumes coming in August and the bearish signal from the macroeconomic environment related to the rising COVID infection rates. Olivier already told you about it. For the end of the year, it might be more complex. The main risk will be, of course, Nord Stream 2. And basically, it could really pressure the carbon prices by getting the gas power plants back into the money, which could penalize the coal power plants. But on the other hand, as you can see on the bottom chart, with the MSR withholding part of the auction volume, the supply of allowances will be quite reduced from September. And this usually strongly support prices. So really, the carbon prices will be torn between the two. And with the still long-term view of the carbon market, we could see some very limited downside potential for the carbon prices at the end of the year. In the longer term, so as I just said, the picture remains bullish because all the reforms presented by the European Commission, even though they came with no surprise, should result in a tighter supply or a stronger demand over the upcoming years. and should support hence the carbon prices. However, last week's publication is only the beginning of a long legislative journey with negotiations between the 3 EU entities expected to last between 18 months to at least 2 years. And honestly, even the 2 years is still quite optimistic. The reforms actually passed into law by then could hence be significantly different from the Commission's proposal, and the evolution of the carbon prices will depend on what changes are actually chosen and the time frame of their implementation, as I presented with the higher LRF and the potential rebasing of the cap. Okay, that's all for the carbon market. Let's go very quickly over the power market, but there's not much to say, to be honest. So as for the power spot prices, as you can see on the left chart, we observed a quite strong volatility over the past months due to the changing weather patterns. But what's more interesting is actually on the left side of the left chart, which represents the average power spot prices in Germany, France, Belgium, and the Netherlands, and compared it to their historical levels and to the clean fuels cost. And as you can see, the power spot prices reach really record levels for the season since March due to the spiking fuels and carbon prices. So basically, if the fuels prices and the clean fuel cost more generally remain at their current level of prices, you can expect very strong power prices in the upcoming months. And it's even more proved by the bottom chart, which represents the power demand. And as you can see, the weather has supported the power demand, but it remained in the historical range. So really, the really high spot prices that you can observe currently are really induced by the fuels market and the carbon markets. As for the nuclear situation, well, not much news there either. Basically, EDF have observed a quite good first half of the year and even increased its 2021 nuclear output target from 330 to 360 terawatt-hours to 345 to 365 terawatt-hours, stating that it had been induced by the good process observed over the first half of the year. But unfortunately, it does not change our bleak outlook for the remainder of the year. We expect a quite low availability in the winter season, and a especially high risk of tension in the Q1 2022. So be careful of that because it could support the power prices. In Belgium, even if it's not the same order of magnitude, the nuclear availability is, on the other hand, expected to be actually quite good for the remainder of the year, with almost all reactors online for most of the months. And that leads us to our last slide, the power forward market and outlook. So you will not be surprised to hear that the power forward prices followed the surging gas and emission prices and reached new records in June and July, as you can see on the upper left chart. On the other hand, the clean spark spread have really collapsed since April due to the surging gas prices mainly. And you can see it there this time on the bottom chart with the gray dotted line. Actually, for the upcoming contracts, so the front month's delivery and even the next 2 quarters delivery, the clean gas cost, so the cost to produce electricity from gas, is above the clean coal cost, which is quite surprising and quite new compared to previously late in 2020 and early 2021. And especially for the winter season. And, well, similarly to the gas market, the calendar contracts are still in backwardation, which is still inconsistent with what we expect due to the quick coal and nuclear phase-out in Germany and Belgium. And this is mainly induced by the gas market. So, and this is a perfect link to our outlook. Maybe for the Cal 23 and Cal 24 and beyond contract deliveries, there might be some opportunity because there is some upside potential for these contracts. For the 22 calendar contract, it's much more complex. The main risk is, of course, Nord Stream 2 once again. And the power market should be even more torn between the bearish potential from Nord Stream 2 and the upside potential from the carbon market with a lower auction supply. So, yeah, you should be really careful for the end of the year. And we could expect some volatility in the upcoming months. Okay, so that's about it for the carbon and power sector. I can now answer some of the questions you might have had.
Etienne, for this presentation. I have a question, global one, regarding the last EU ETS reform that you presented into details. Do you think it can lead to a significant reduction in the CO2 emissions of the industrial sector in Europe?
That's a very good question, actually, and it could be the main subject of the EU ETS for the phase 4 of the system, because you may not know, but most of the reduction observed in the EU ETS installation have come from the power sector so far, basically by increasing the renewable production, and over the past years by switching from a coal-based power production to a gas-based power production. Unfortunately, this potential is nearly exhausted. And now the EU ETS prices could be based on the industry abatement costs, which are much higher. But to be honest, I don't expect a significant reduction of emissions because, well, first, as I said, the cost abatement are much higher. Most of them are above 100 euros per ton. And you need prices to reduce emission, you need to make long-term investment. You need prices to be sure that prices remain above this cost abatement. So basically, carbon prices need to go much higher to induce significant reduction in the industry sector. So we could see it near 2030 if the reforms are quite efficient, but not in the short term now.
Okay, one last question. What do you think about the physical risk for power generation, notably in Germany next year with the end of the nuclear phase-out plan?
It's also a very good question and quite hard to answer. So basically here, the issue is that it's hard to anticipate the impact on prices from, on one side, the nuclear phase-out and coal phase-out, which both will have a supportive impact for prices, and on the other hand, from the increasing renewable capacities. So we expect, of course, the increasing rate of renewable capacity to be slower than the quick coal and nuclear phase-out. So it should be very supportive for power near-term prices. But it's hard to say because some coal power plants will need to remain online for security of supply, or basically because they had already edged their production. So it's quite hard, but it should be supportive for prices.
Okay, thank you, Etienne. So it's the end of the presentation now. So before I close the presentation, can you please answer our short satisfaction survey? So it's only 2 questions. So I will give you 1 minute. So during this survey, I will just give you the outlook for the coming months. So the next webinar session will take place in October. And so regarding the event calendar for notably for natural gas markets, we talked a lot with Evariste about Russian gas and notably Russian gas transit. Note that the next monthly interruptible capacity auction will take place next week on the 27th of July. At the beginning of August, on the 2nd of August, we will have the quarterly transport auction. And this could be also a key market driver for the remainder of the summer period, notably as we will have more clarity maybe about the Russian gas transit through Poland and the Yamal pipeline. And of course, the next key political event for natural gas markets and energy markets in Europe is the German general election on the 26th of September. So that's all. I will close the survey. Thanks for those who took the time to answer. thanks again for your attention. And it's now time to close the session. I hope you enjoyed it. So see you soon on our EnergyScan platform. Goodbye.